Welcome everyone to Vested Interest. This is Shane, and before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. For those of you who may be stopping by for the first time, well, it's not rocket science. In my opinion, the best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, buying dividend growth stocks, and growing companies with positive cash flow that covers the dividend, and companies with a high return on their invested capital. I utilize both a dollar cost average approach, consistently investing into the stocks within the portfolio on a minimum of a bi-weekly basis whenever I get paid. Pretty much it's every week. But if I have extra funds from a bonus or a side job, I will do a big purchase as well. I cover all my investments into this portfolio on the channel. I do not have a paid Patreon account. Every Sunday morning at 7:30, I do a portfolio update so you can see what I'm buying, see what I'm selling, any option plays that I have, exactly what's going on in my portfolio. Full disclosure here. No paid Patreon account or firewalls or anywhere else you have to go to see what I am doing. We all have enough to pay for, so again, it's free to see what I'm investing in. But if you would like to help out the channel, dropping a comment and let me know what you think of the videos, hitting that thumbs up, liking the videos, and subscribing. Hit that subscribe button down below and hit that notification bell. That really helps out with the YouTube algorithms and helps out a small YouTube channel like myself tremendously. So I really appreciate it if you do that. There's a Webull link down below if you wanted to use that to open up your own brokerage account. That is another way you can help out as well. You'll get some free stocks. I'll get some free stocks. Again, you don't have to use that. That's completely up to you. I don't cover my Webull activity. That's more speculative in nature on this channel, so I keep that one off to the side. It's a much smaller portion of my portfolio, less than 5% really. Well, in today's video, we will be covering the 5 stocks I am looking to buy in the month of July. CVS is a recently added position. Pfizer, I'd like to look to continue to build out. Stillwater, another one in the portfolio that I'd like to continue to build out. I see a lot of value in that one right there. Realty income, if it pulls back under 60, I'd like to continue to adding there. And this one would be another one I'd be adding back into the portfolio. NextEra Energy. Let's jump right in and take a look at these 5 stocks to buy in July. Now, this is my investing criteria. I need to change that. I've recently started calling this the vested interest stock screener. So this is my stock screener here, right? Understand the business, growing free cash flow over the last 5 years and expected into the future. A growing dividend. We all want to see our dividends grow over time. Dividend payout ratio of 75% or less. This does not apply to REITs or BDCs, companies like that have to pay out a higher than average amount of their free cash flow. Check valuation based on dividend yield theory, right? If the current yield is above the 5-year average, it equals a buy, it's undervalued. If the current yield is below its 5-year average, it's a hold, it's overvalued. And if the current yield is equal to 5-year average, it's considered fair value. Buy below current cost basis or within 15% of its 52-week low. So if it's one that I have in my portfolio, I want to be adding whenever it's under my cost basis. If it's one I'm looking to add to the portfolio, not already in there, I want to buy whenever it's within 15% of its 52-week low or lower, right? As low as possible is what we're looking for really there. Return on invested capital and return on equity equal to or greater than its industry average, or 10% or plus on both. And if it's a financial company like a bank, we're going to throw in price to book as an extra metric. When the price to book is near 1 or lower, it's considered fair value, or under. If it's under 1, obviously that would be undervalued. And for this, it must meet 4 of the 7 to be investable. If it's not a financial company, if it is a financial company, 5 of 8. So first on our list, we will take a look at Pfizer, ticker PFE. Out of the healthcare sector, closed out the day, at least the last trading day there, Monday. The market is closed on July 4th. Happy 4th of July to everyone out there if I didn't mention that in the opener. Hope you're having a wonderful weekend. Back to Pfizer again, close out the day at $36.65 there Monday. And 52-week range as low as $35.76, as high as $54.93. So right up against their 52-week low. That's part of the reason we're looking to continue to add them here. Market cap of $206.901 billion, a beta of 0.59, less volatile than the overall market. Price to earnings PE ratio is $7.23 per share, very low here. EPS earnings per share is $5.07 per share. That's a very nice number. Earnings date coming up on August 1st. Forward dividend is $1.64 paid out on the year. They do have a very nice dividend yield, $4.45. They are a quarterly payer. Ex-dividend date is July 7th. They will pay out on September 5th, so you would be in line for the next dividend payout if you bought them now. 1-year target estimate, at least according to Yahoo Finance, $46.23. They say it's 3% undervalued right here, real near fair value in their estimate. They also, this is more for traders, right? They have a bullish pattern detected. It looks like in the short term, they think it might be, which is kind of contradictory. If they have a bullish pattern, this should be short term would be going up. But it looks like in the short term, they might see it pull back or stay up against this 52-week low. Midterm, maybe that's the bullish pattern they're looking for. Looks like it might go up and then long term back down a little bit. So this one, Pfizer, over the last year or two, it's been doing that, right? It stayed hovered right around this 52-week low. If you were lucky enough to buy it here a couple years back, like I did, around the mid 30s, I rode it up to about mid 40s, sold it, and then now I'm back into it right around $38 per share. My cost basis, I am long Pfizer, 165.399 shares, down a little bit, 5.22%, but again, my cost base is $38.67. That's where I'm comfortable. Anything under that. Let's keep running through this one here. Dividend yield theory. According to dividend yield theory, they have a 5-year dividend average of 3.62. Let's compare it to their current dividend yield, 4.45%, or forward dividend yield over here. If you were to go into statistics, you'd find this down in their dividends and splits. And because it is quite a bit higher than their 5-year average, that speaks to some undervaluation. So that's part of the reason we're looking at this one here. Very low payout ratio, so a lot of runway to continue to raise the dividend on this one, only a 31.76% payout ratio. Another one that I like, return on invested capital, return on equity. So I like 10% or better. On both of these, return on equity 30.90 and return on invested capital 31%, smashes the 10% I'm looking for. Very nice numbers overall on this one. Let's check out free cash flow. 2019, $9.9 billion. 2020 up to 11.6, 2021 big jump to 29.86. From 2021, a little bit of a drop. This is that CV19, right? The big jump up from 2020 to 2021 was because of the COVID issues there. And the drop, same thing, as that is tailored off, we'll see a drop in there. Not as concerned with this, but overall 2019 to 2022, big growth in the free cash flow. That's what we want, growing free cash flow so those dividends can grow over time. And again, Pfizer is out of the healthcare sector. That's number one of the 5 we're looking at this month. Next up on our list is another one out of the healthcare sector, CVS, ticker CVS, again out of the healthcare sector, closed out the day Monday at $69.77 here. 52-week range as low as $66.34, as high as $107.26, right up against their 52-week low. This is another one that I bought a couple years back, right around the same area, around in the 70s, low to mid 70s. Rode this up to about $100 per share, sold it. Now I'm back in it again. Full disclosure, I do currently have 10 shares. I also have, in my cost basis is $69.38, so right up against where it's at right now. I also currently have a put on this one at a $69 strike price, right? So if this happens to hit, I will pick up those 100 shares. That will close out on Fridays. We'll see where we're at. Either way, I will roll this into another put if we don't get these hit, and I'll roll that up to about $72 per share, and then I'll stop the puts if I haven't been assigned those shares. But it's a way to collect some extra cash flow there. Let's jump back in here to the overall breakdown of CVS. Again, 52-week range as low as 66.34, as high as 107. Market cap of $89.447 billion. A beta of 0.61, so another one less volatile than the overall market. I will say the PE ratio, price to earnings, $22.95 per share, is a little elevated on this one. Not as concerned with this. They are reinvesting some capital here, buying and building out some those quick clinics inside there, and kind of transitioning CVS into more of a holistic healthcare provider. They also have their hands in healthcare insurance. I'm not sure if a lot of people are aware of that, right? So they have an arm in healthcare insurance, building out some clinics so that they won't just be providing some groceries and pharmaceutical companies, but they'll also provide a spot for you to go in, get some shots, get your temperature taken if you're having some health issues, instead of going into a hospital. They're like those quick clinics, right? So not as concerned with that because they have some growth coming down the pike with these changes. We'll see how that works out. I just like the valuation right now. EPS $3.04 per share. Earnings date coming up August 1st to August 7th, sometime in there. Look for that. Forward dividend is $2.42 with a very nice, this is a quarterly payer here, very nice dividend yield, 3.55%. Ex-dividend date was April 20th. Looks like they paid out on May 1st. So you should be in line if you bought them now. And I'm surprised they haven't updated. They'll have another one coming up here So you should be in line for the next dividend payout ratio, or the next dividend payout. 1 year target estimate, at least according to Yahoo Finance, $97.34. So speaks to some upside appreciation for the stock price here. They say it's near fair value. Actually, they say negative 1% estimated return, so a little bit above fair value, but that's fine, right at fair value in my opinion. And another one, if you're a trader, they say bullish momentum. So short term, it looks like it's going up, mid-term going up, and long term possibly a little bit of a pullback. Now let's look at dividend yield theory. Same thing here. If you were to go into statistics, go down to dividend splits, look at their 5-year dividend average, 2.80. Compare it to their current 3.55, same numbers, right? They call it forward over here. It's just the current dividend. And it is much higher as well. So this, again, according to dividend yield theory, speaks to some undervaluation here. Their payout ratio is a little elevated, just under what I look for, 75% or less. You could call that right at the threshold there, 75%. Return on equity and return on invested capital. Again, we like 10% or better, or in line with their industry average. And this one, 5.5% for return on equity, and return on invested capital 6.90. Even though they're under the 10% that I like, they are in line with their industrial average, which is healthcare sector. And really, I look at this one compared to some retail stores, right? It is primarily a retail store. So compared to retail, it is right there in line with this industrial average, even though, like I said, they do have their hands in healthcare and are going more into it. So as they transition, I'll compare them more to companies like we saw previously on Pfizer, but I'm not as concerned with this one here at these numbers. Free cash flow, 2019, $10.3 billion. 2020 jump up to 13.4. 2021, 15.7. Same thing. CV19 here, we saw a big jump from 2020 to 2021, back to where they really should be in 2022. But overall, from 2019 to 2022, 13.45 billion. So nice free cash flow growth there, pretty steady. And I think we ran through my positions here, but I am long. Currently I have 10, have the put on, so looking to have 110 by the end of the week or by the end of next week. So I'll roll that put over if we don't get assigned. CVS is number 2 on our list. Let's keep on going. Number 3. Stillwater, this one was on last month. We're going to keep it on here. Still seeing value. Ticker SBSW. This is a mining company out of the materials sector here. Closed out the day at $6.39. This one just continues to drop. 52-week range as low as $5.96, as high as $12.44. So another one right against its 52-week low. They consider it very undervalued. 80% estimated return. I don't know if I buy that, but I agree it's undervalued here. Market cap of $4.522 billion, a beta of 1.23. This one is more volatile than the overall market. Price to earnings PE ratio $4.60 per share, very low. EPS earnings per share is $1.39. Very nice number here for a mining company. They do not have a earnings date here, so I would look maybe at their homepage and see if they have one coming up. For dividend is 53 cents per share. Now this one is a semi-annual payer. Look for this a couple times a year, so this is going to pay out around 25 cents per share each time they pay out, not this 53 cents. Very nice dividend yield, 8.37% yield here. Ex-dividend date was March 23rd. They did pay out on April 6th, so you would be in line for the next dividend whenever it was, I would say, towards the end of the year here. 1 year target estimate at $11.48, so speaks to some upside appreciation on this one as well. Again, if you're a trader, they see a neutral pattern detected, short-term down, mid-term down, long-term down. This one may be down for a while, especially if we see the market recover. Metals typically take a backseat as the market recovers, but that's a good time to buy, right? If things are pulling back, that's when I like to look at them. Let's look at dividend yield theory. 5-year dividend average not applicable here, so we can't really run a dividend yield on this one. Just know it has a very high dividend payout, 8.37%. And payout ratio at 49.99%, low. Lots of room to expand it if they wanted, buy back stocks, whatever they wanted to do, reinvest in new mines, that sort of thing. Let's jump down and look at return on equity and return on invested capital. ROE is return on equity sitting at 22%. Return on invested capital sitting at 24.10%, much higher than I like, twice as high as the 10% I look for. So very nice numbers all the way around. Let's jump over to free cash flow. 2019, $1.75 billion. 2020, big jump from 2019 to 2020, $17.5 billion. Another big jump from 20 to 21, $19.5, and then a huge drop, and this might be part of the reason for the pullback. But this is metals. That's one of the things they do. Ups and downs are part of it. You have to be willing to ride it out. And whenever the downs happen, this could be reinvesting into new mines. They have had some strikes there, some issues internally. So that's the time I look at it. Whenever a company is distressed, I don't mind buying at the cheaper prices, but they do have negative free cash flow in 2022. So we'd want to watch and see what they're doing in 2023 to make sure this is not a pattern. Hopefully we'd see a jump back up into the 17, 16, 15 range, somewhere in there. And again, I am long Sabina Stillwaters. I have 481.77 shares. I am down significantly in this position, 31.74%. I was buying this in the $10 ranges. I have been continuing to dollar cost average and bring my cost basis down to $9.36, but it's still much higher than where it currently sits. And I will probably continue to nibble 10, 15, 20 shares at a pop on this one as it stays low here, and then wait for the rebound back into the 11s, where I think it's going to head eventually. Sabina Stillwater, that is number 3 on our list. Again, ticker SBSW, out of the material sector. This is a mining company here. I know some people don't like mining companies, and if you don't like them, just don't invest in them. Next one up, Realty Income. I think a lot of people like this one. This is a monthly paying REIT here, ticker O, out of the real estate sector. Again, if you're a dividend growth investor, you're probably aware of this company. A lot of people like this one, very popular in the dividend investing community. It is a REIT. And 52-week range as low as $55.50, as high as $75.11. So not right up against its 52-week low, but I'd like this to drop back under 60s. I've been adding to it in the $58, $59 per share range, and that is where I like it, or below. Now, Yahoo Finance says they're 28% overvalued, right? They have a negative 28 estimated return, so that means they feel this one's overvalued. I don't know that I necessarily agree with that, but they could be right. And if it was to pull back significantly, I would just add and bring down my cost basis. Market cap, there's a helicopter going by. I apologize for the noise. I don't know if you've watched my videos any length of time. You know I'm not too far from a Selfridge Air Force Base here, a little further north of me, so we get those quite a bit. Market cap of $40.528 billion, beta of 0.80, so less volatile than the overall market. Price to earnings 42.39. I do not look at this. This is not a good metric for REITs. What you want to look at is for funds from operations. That's the better metric for REITs, but if it was a good metric for this, that would be elevated. Again, not concerned with that. Earnings per share, EPS, $1.42 per share. Earnings date is coming up sometime between August 1st and August 7th. $3.07. They are a monthly payer, so you divide this by 12 to get their per share payout here. Very nice dividend yield, 5.10%. Very, very nice dividend yield. Ex-dividend date, June 30th. We just blew past that. So they are going to pay out on the 14th, so you would not be in line for this July 14th payout. You'd have to wait to buy them for their next dividend payout. 1-year target estimate, at least according to Yahoo Finance, $69.48 per share. So it does speak to some upside appreciation. Another one for you traders out there, they're seeing a bearish pattern. Short-term, mid-term, and long-term down. Probably has to do with the elevated rates, and I would agree if rates continue to go up, REITs will get hit, and that would be somewhere I would look to see some value. And make sure you're doing deep dives on these REITs as rates go up, because it will impact their ability to get loans. And with higher interest rates, right, the REITs that aren't very good at managing their funds, they will get hit the hardest. Just keep that in mind. Let's jump over to dividend yield theory. Again, under statistics, if you're going to dividends and splits, look at their 5-year dividend average, 4.29%, currently at 5.1, so they are higher. Their current is higher than their 5-year average. That speaks to some undervaluation according to dividend yield theory. If this number was lower, that would speak to overvaluation, but again, it's higher, so potentially undervalued here. Payout ratio is elevated, 210%. That is not good. If this was to continue, I would start to worry a little bit about Realty Income, because that is, I don't mind it over 90. They have to pay out over 90% for REITs. But to be twice what they should be, that's a little high. 110, 120, somewhere in there, not terrible, but 210, that's getting up there. We looked at the ex-dividend date. Let's look at their return on equity and return on invested capital. We like 10% or better, or in line with their industrial average, their industry average. This one at return on equity 3.2% and return on invested capital 2.60. They're a little low, but not so low that I would be concerned. Free cash flow next up on the list. 2019, $1 billion. 2020, $1.1 billion. 2021, $1.3. 2022, $2.5. Very nice, steady growth over time. I would expect the same going into 2023. Maybe not as big of a jump from 2021 as 2022 to 2023, but overall 2019 to 2022, nice steady free cash flow growth here. That's what you want to see. And I am long Realty Income, another one that's already in my portfolio. I'd like to just continue to build out this position. I am down again 4.03% on this one, so down on a lot of these positions. I don't mind continuing to lower my cost basis, continue to add here, and add to my future potential returns. So Realty Income, number 4 on the list. And last up, NextEra Energy. Now this will be not a new position. I did own this at one time as well. You'll notice a lot of times I'll buy a position. If it runs way up, I might sell it and wait for it to come back down, book those profits. I don't mind booking. You can't lose money if you're booking profits, so this would be another one where I've done that. But NextEra Energy, I'm not currently holding any shares of this one. Ticker NEE, out of the utility sector here. I do not currently have anything in the utility sector. This is one I'd like to add. And it closed out the day at $74.38 here. 52-week range as low as $69.64, as high as $91.35. So they are right up against their 52-week low as well. Not right up against it, but pretty close. And according to Yahoo Finance, they have a right near fair value, 1% estimated return, so slightly undervalued according to them. Market cap of $150.502 billion, a beta of 0.47%. So most of these were less volatile than the overall market, I think, other than Sabini Stillwater there, but another one here, 0.47, that's less volatile than the overall market. Price to earnings, PE ratio, $21.94. Not as concerned with this one. This is another one. They are transitioning pretty quickly to renewable energies here. NextEra Energy is. So they are doing a lot of investing, and utilities in general are capital intensive, a lot of money to upkeep their systems. And this one, like I said, is reinvesting in themselves right now. A lot of wind projects, a lot of solar projects. So not as concerned with this price to earnings ratio elevated like this one. I would say this would be high if I didn't know as much as I do about the company. EPS, earnings per share, is $3.39. Very nice. Earnings date, July 20th through the 24th, sometime in there. Excuse me. Ex-dividend date, May 26th, so we just blew past that. Looks like they paid out, did I not put that down? I didn't capture that, apologize. June 15th maybe was the dividend date. Okay, so they should be in line for their next one. So they paid out June 15th. I didn't capture that. I just didn't capture the ex-dividend date. So they paid out June 15th. You would be in line for the next dividend on this one if you were to buy them now. Same thing for you traders out there. They see a bearish pattern, triple moving average crossover. I have no idea what that means. If you're a trader, let me know down in the comment section below. I'm not a trader. But that's what this section of is really for, short-term traders, people looking at the patterns in the charts. I don't do that, but if you're out there, let me know what that means. What's a triple moving average crossover? I don't know. I'll have to look it up. Short term, they see it going down. Midterm, they see it going down. Long term, they see it going down, which is part of the reason I'm looking at it. I'm hoping that it stays under the $74.38 per share. I would love to just pile into this one and be able to pick them up as it's coming down, right? Not a bad place to be on this one. Let's keep going. Dividend yield theory, right? The trailing annual, the 5-year average dividend yield is 2.12, current 2.55, same number, 2.55. So according to dividend yield theory, it speaks to some undervaluation in this one. Payout ratio 51.71%, so under the 75% that I look for here. Very nice, gives them lots of room to continue to increase this dividend payout over time. Return on equity, return on invested capital. Return on equity smashes the 10% we're looking for, 17% currently. Return on invested capital, a little low, 5.20. But again, a lot of the newer investments that they're making, right, in the wind turbines, in the solar, they pay out over time. So I could see how that might be a little low if they're investing in things that aren't going to pay them out for another 10, 15 years, right? That's the idea behind those. It's not going to pay you initially, but it'll pay you out over the long term. I can see how that'd be a little lower. Free cash flow is the last one we're going to look at here. In 2019, negative $2.9 billion. 2020 was in the positive, 224 million. 2021 back in the negative, negative 227. 2022 negative. You're going to see negatives for these typically in utilities. If you look at a lot of utilities, you'll see their free cash flow like that. And again, very capital intensive. They are reinvesting in the company. I would pay attention to the payout ratios. So long as their payout ratios are looking good, don't necessarily worry about this. They will reinvest in themselves quite a bit, and there are ways that they can use their financials to, even though this is a negative, they're able to write some of this down over time. And if you know anything about companies and how they're able to write assets down, you would understand that. But if you don't, it's not going to make any sense. But anyways, NextEra Energy is number 5 on our list. This one is one that I'm looking to add back into the portfolio. And that really wraps up this one. Those are the 5 I'm watching for July. As they present value, I will add them to the portfolio. If it's NextEra Energy, it will be a new position. If it's the other 4, it will just be adding to the existing position within the portfolio. What are you watching for July? Go ahead and drop it down in the comment section below. As always, appreciate you stopping by, especially on this 4th of July. Happy 4th of July, and hope you had a great 4th of July weekend with your family. I've had the last several days off. I did not put out a video yesterday for the Stock Pick of the Day series because I enjoyed the day with the family. Hopefully you are doing the same. And again, as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Drop a comment down below. Let me know what you think of the video. Let me know what you think of the 5 stocks we covered today. What are you watching for July? If they are not those 5, let me know. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. If you have some stocks you'd like me to cover in the Stock Pick of the Day series, or just cover in general, go ahead and drop them down in the comments. I will work them into the rotation. Again, happy 4th of July. Hope you're having a great day. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount not comfortable losing. Always do your own research, investigation of your situation, circumstances, and select criteria, or seek the advice counsel of a certified financial advisor.